Welcome back. Let's get a check on the fixed income market. And to help us unpack this, we have joining us Oladipo Ajayi is the head FX and fixed income at Chapel Hill, Denham. Great to have you on the show. Happy New Year. Good morning.
Good morning, Ladi. Happy New Year. Nice having being on your show this morning.
Yeah, always great to have you. But we know the action now. The markets have started, action already, and the fixed income market not left out. We're seeing some contraction there with average benchmark yields for the OMO and NTB bonds, while in the secondary bond market, we saw some expansion of yields there. Help us understand what's playing out in the market.
Okay, what happened is that at the beginning of the year, the DMO actually released the calendar for the treasury bills issuance for Q1. And what we noticed was that the total maturity that we are expecting in Q1 is about 5.2 trillion, and the total issuance for Q1 is about 4.3 trillion. So what that means is that there will be net inflow of about 900 billion hitting the market in Q1. So the signal that this sent to the market is the fact that market is expected to be a bit aggressive in that direction, and that's one of the reasons why you are seeing that from the last NTB auction, where the rate closed around 22.66 levels. Now the same instrument is trading around 21.5% in the market. That's about 110 basis points from where it was actually issued about a fortnight ago. And exactly the opposite is what's happening in the bond market, because when the calendar was released, we noticed that the DMO is ready to issue about 1.8 trillion in Q1. So that's like an average of about 600 billion on every month in Q1. And so the signal that they sent to the market is more like that simply means that the government will continue to crowd out the bond market, and that led to a lot of people trying to actually sell their existing position in anticipation of the new incoming bond. And one thing also that we noticed is that the new calendar shows a new 10-year bond. Although the DMO is currently reopening the 2029 and also the 2031, but there's a fresh 10-year bond. Now, one thing you all know across the world is that 10 years is more like a benchmark bond. So anyone that's actually investing in the market will want to hold a 10-year bond, because it's more like a metric to calculate a lot of investment return. And I guess that's one of the reasons why we are seeing a sell-off in the bond space, and we are seeing a lot of interest in the treasury bill space.
Right. And what are the potential implications of these yield movements, for the Nigerian economy, including, government borrowing? We got that data earlier today, total debt stock hitting 142 trillion. So, definitely we're seeing debt still ballooning at this time. Talk to me about how this impacts the Nigerian economy, because we're trying to get somewhere, in 2025.
Well, the sense that the market is having from the budget for 2025 is that the government is still a bit bullish in their borrowing structure. And one thing is that, when you are bullish to borrow, it means that you borrow at elevated rate. I think the only solace for the government is the fact that we may see a less aggressive monetary policy guide for the year 2025, considering the CPI rebasing, and coupled with the fact that we'll likely enjoy a bit of high base year effect, which will actually necessitate the monetary policy guide to actually hold for a major part of the year, and maybe later part in the year start looking at actually cutting rate. And I think that the global economy is also one way or there could be more like a solace as well, because we're seeing global inflation actually retracing, and what that simply also means is that we could start seeing a bit of more inflows to our market. So for me, I think that we are still very much aggressive when you look at it all in all, and it also simply means that this year 2025 may not be greatly different from what we saw in 2024, where the corporates have found it very difficult to actually access the capital market to raise to raise bonds. Imagine last year where the government is borrowing at 22%. Of course, an average corporate that wants to come to the market to actually raise a 7 to 10 year bond will actually pay close to about 28 to 30% to actually raise funds in the market. So it shows us that the government will still continue to crowd market in year 2025, and also means that borrowing for most corporate will be elevated at least the first half of the year, and that may not be too great for them.
Right, and looking at the naira so far, the trades we've seen, it's a midweek trading session that's opened at this time. How are you seeing the naira trading for this week? Are we still going to see that range we're used to?
I think if you notice from December 1st, when the MFM platform was launched, we've seen a bit of calmness in the markets, and because what that platform brought to the table was it brought market depth, it brought price discovery, and also, so it simply means that you can actually see at a glance what is happening in the market. It's more like it's not like the opaque market that we used to have, that you don't actually know the total volume of demand in the market. So that has actually kept the currency stable for over time. And there are times when there are a lot of interest in the market. You are seeing more bid than offer in the market. We tend to see the central bank also coming into the market in such a time like that to actually intervene in the market and sell FX into the market. But the good side part of this platform is the fact that it's an anonymous platform where you don't even know who is buying or who is selling. So when central bank comes to the market, you don't even know that central bank that is coming to the market to sell. Maybe at the end of the day, when you need to settle, you get to know your seller, and I think that also has actually helped the market. So I see this market more stable the better part of this week. Even in Q1, we may likely be seeing more of what you mentioned as the range trading, where market move up and it comes down. So it simply means that when Naira is looking heavily on the price, we will tend to see the central bank come to the market to actually sell FX into the market. And we have seen that also impact the foreign reserve. At the beginning of the year, the foreign reserve opened around 40.87 billion. Currently, we are around 40.1 billion level. So it simply means that there has been a bit of outflow on the part of central bank to actually help to actually stabilize the market. Of course, that is what is expected of the central, because currency stability is also within the confine of their responsibility. And they mentioned clearly to the market that the currency is not fully floated. It is more like a managed floating system. And I think that's the way the central bank will continue to go around this at least in the foreseeable time.
Right. And we know in 2024, we tapped the Eurobond market after a long time, after a hiatus. And now, seeing the body language from the U.S. Fed, it was supposed to be about 4 cuts in 2025, but now it's been reduced to about 2, and they're anticipating, how the Trump's policies will impact inflation, going into 2025. So did we tap the Eurobond market at the wrong time?
Well, I think we went in at a good time because sincerely speaking, the time when we went to the market was just to borrow to actually fund the 2024 budget. And if you look at it very well, we went in towards the end of the year. At the beginning of the year, we still saw more like not so dovish Fed at the beginning of last year. And of course, they promised that we will see rate cut at the later part of the year. And so what the government did was that they waited till about the time when we start seeing the posture of the Fed change to more of that extremely dovish stance. And that's one of the reasons why we went into the market at that particular point in time. And you can actually see the level of subscription, which also shows the fact that a lot of them are actually attracted to the instrument because we saw close to over $9 billion worth of subscription at that auction. So I think that we went in at the right time last year. So for this year, we just need to actually time the market appropriately as well. We need to actually follow what the US Fed is doing. We need to follow what will be the impact of Trump's administration's policy on the economy, both on the US economy and the global economy. And that's so as to be able to take advantage of that window that will be open. and be able to raise funds at a lower rate. Just last week, the Benin Republic was in the market to raise a Eurobond, and they were able to raise a 16-year bond at around 8.625. And I think that's a very good one for that level of tenor. And I think also that the window is still very much open, but we can actually wait for a better time that we can capitalize on the market and raise at a lower level.
All right, definitely. All eyes on most of these markets. Most years, the previous year, 2024, we had most of the doom expectations for most of these economies, but we still saw risk assets do really well. I wonder what's going to play out in 2025, but we'll keep watching. Thank you so much. That's Mr. Oladipo Ajayi, Head FX Fixed Income, Chapel Hill, Denham. Thank you so much for coming on today.
Yeah. You're welcome. Thank you very much, Olaji, for having me on this morning.
All right, so the markets are open. We'll give you a broader perspective on what's playing out for the local bourse and most of the global markets that we track. That's at 1 p.m. on Business Incorporated. Stay tuned for that. That's it for me on Business Morning. I hand things over to the Sunrise Daily team.